What are the pros and cons of actively managed versus index ETFs?
Okay, so first of all, an ETF is an exchange traded fund. It's a basket of securities, could be stocks, bonds, those would be the most common anyway. They have all kinds of different ones, but uh, and so it's a big, number. It can be 30, it could be, 7,000. There's
Hmm.
some place in between there in terms of the number. And they trade though like a stock. It's kind of fascinating because it's you can see the quotes every second essentially, and you can buy and sell them by the minute. You can put stop losses because we always had mutual funds before,
Hmm.
right? And mutual funds were mostly actively managed up until Vanguard really got going with the
Yeah.
indexes, where they got rid of a manager. So actively managed mean there's a manager who is picking and choosing those things that are in the basket.
Yeah, essentially they have like an investment strategy or
Mhm.
something like that, and then they pick and choose stocks to fall or
Right.
investments to fall within that.
There's all kinds of different concepts. It
Yeah.
could be growth and value. It could be niche things like, you know, uh, someday
Like
AI, right, doesn't
AI,
exist, right?
solar,
Right.
it could be
Solar,
anything.
yep, right. So you might, maybe if I'm an actively managed solar manager, I'm really into that industry and I'm looking at all the different parts of it and, choosing, and really in a way, an index would have maybe all of those holdings.
Yeah.
And what would happen with an active manager is essentially, and this is one of the advantages of an active manager theoretically, is they would have some that they don't own,
Yeah.
right?
Some they don't like for certain reasons.
So let's say it's a solar index that we have and it has, I don't know, 150 stocks, and I'm an active manager and I have 50 stocks. That means I've chosen not to buy those other 100 because they don't meet my criteria, my
Mm.
screens, right? And so there's pros and cons to that. It's really kind of fascinating. So if you just look at kind of selection, can somebody do a great job of deciding which 50 out of those 150 to choose,
Yeah.
right? So you can see track record and such. There's a school of thought that it's very difficult to do so if I just buy them all, right? Which is what you do with an indexed ETF, because you might be very surprised. I mean, Meta's a great example, to be honest, right now. I mean, there's a lot of people that didn't think Meta was going to come back at all for a while there. I mean,
Hmm.
when they were selling that out at 40% drop and what have you. So, I don't know. If I was an active manager, I might have sold my Meta out of my S&P 500 pool and narrowed it down to these 100 stocks out of the S&P 500 that I really like. I'd have missed out on that 20% run today,
Hmm.
right? So that's one of the pros and cons. How good are they at choosing those positions and what do they leave out? We kind of, personally, what we do here is we have, 3/4 of our portfolio in broad index
Hmm.
pieces. We
Yeah.
try to buy everything because we know how difficult it is to get which ones are right. And the other 1/4 of our stock or bond holdings are in these more targeted areas. We're riding these waves and we're trying to capture some of the returns that might push us over and above the market, right? So
Yeah.
that's how we do it. So now, the one of the disadvantages of a of an index is, again, there's some stuff that's really bad just because it's in the index, right?
Hmm.
And so stocks that are struggling or have too much debt or have all kinds of problems or what have you. I mean, 3M is a great example, right? 3M was it's up down about 67% from its high, and it's had some issues with and that's in the S&P 500. I think it's in the Dow, right? I mean, and good company, probably going to do great long term, but an active manager might have gotten out of 3M
Yeah.
for a while, right? And waited, not have to go through that downturn with them. They have some issues with some of their products and different things that are
Yeah,
going
and
on.
so you're paying extra
Mhm.
essentially with these actively managed ETFs. There's usually higher expense costs
Right.
on ratios on them, and so you're going to pay a little bit extra for that expertise versus a broad market index. You're basically just paying what very little in cost.
Yeah, I mean, for example, with some of these broad market ETFs at Vanguard, you might pay 0.1% or less, right?
Yeah.
And with some of the actively managed ETFs, you might pay 1% or more. Depends on the ETF. And so that's a pretty big differential. It means the active manager has to overcome that difference
Yeah.
just to break even with the index that you could buy yourself. And so, that's kind of like a parachute that's holding you back, so to speak, when you're trying to move forward. And so that's one of the big ones is the differential in cost. However, personally, the way I would look at this, just in my own world, I don't really care about the cost if they're outperforming after that cost,
Hmm.
right? Because it's the same. So if I'm paying 1% more, but it's producing 2% more, I'm ahead.
Yeah.
So the way we do it is we have, like, for our target things, not the core pieces, the big broad pieces, but for our target pieces, we have these big lists, maybe 180 ETFs. Some of them are actively managed. And so if they can move up to the top and go and show us that there's momentum behind there, I'll buy them,
Yeah.
right? It often doesn't happen, which is interesting. We haven't seen a lot of those come into our portfolio. But
Yeah, and there's also, another thing with actively managed is if you want to target like a certain idea or theme. So let's say I want to do, for example, I want to do biotech companies that have gotten FDA approval for their drug.
right,
Essentially, that's super niche. You're not going to have a broad market index to fit that, and
right.
so you can grab this ETF. You're going to pay a little bit more, but they're going to screen for those specific company.
Yeah, and again, if you pay more and make more, it still works. It's just, it's harder. Yeah.
Yeah,
And so, yeah, exactly right. That niche concept where you really find something that you want to, pursue and put some money in. And so, yeah, that's kind of the differences as far as I'm concerned. I don't have any problem with either one of them. I know that there are some people that are really, really into indexed everything, and it's almost evil to talk about the other things, but return is return.
yeah,
I have to be really brutal about that. I mean, our job is to get return, period. I mean, if we want to keep our job, we have to get return. If an active manager can do that over an index, I'm all for it. But they have to prove it and they have to continue to prove it because it's free for us, commission wise, to get out of these things. So
hmm,
that's kind of I don't have an allegiance to anything. You just got to perform. My job is to get the most I can for the risk level that each client has accepted. And it's really, wherever, I don't care where it is, as long as it fits within that risk level and it's moving, right?
yeah.
At least for these target things that we use.
Yeah, if you're investing on your own, you want a simple strategy, broad market indexes are great.
Mm-hmm.
But if you're a little bit more advanced, do it yourself or, targeted indexes could be helpful.
Yeah, nothing wrong with just doing broad indexes all by yourself, especially. I think that's the way to go. Matter of fact, I think, most people that don't have all day, every day like we do to spend working on it probably should be doing that, including Warren Buffett. That's his recommendation for the general public. Buy the S&P 500 and buy these broad indexes, and I don't think he's wrong at all in that
Yep.
category. Our job is a little different. We're trying to beat those indexes, and so that's we've got a little bit. We want to make up our fee, right?
Mhm.
So that's a big one.